let's say we buy the logic up to this point, which is that there's going to be two software change events that are very that material to the mechanics of who sells Ethereum on a set schedule, this EIP 1559 and proof of stake. In the aggregate, it will reduce that like background sell pressure by 90%. How do you argue from that to your price target of $150,000 per ETH by 2023?
Yeah, so from there you have to, so from there in a Bitcoin halving, a first part of the move is going to be the structural flows. But the last part of the move is narrative. And that's why you see it crash, right? Because if it was all these structural flows, when Bitcoin fell back down, you would expect that those flows would kind of like pick it up, right? And so how does Bitcoin crash so much? I mean, I think it's what prevents Bitcoin from crashing as much as, Ether crashing 95%. I definitely think the halving helps there, but I do think like it will crash that much because at some point, what's driving it up higher is just narrative adoption mania, people going, oh, this might be interesting, and starting to like become Bitcoin believers. And I think the same thing is going to happen with Ethereum. And so then I was asking myself, well, how do I ground that? And I think a lot of institutions have already started looking at Bitcoin and looking at Bitcoin pricing models. So what I did was I said, okay, I think as a base case, a lot of institutions I can just use a fundamental analysis kind of style to figure out where institutions will buy up until. Like, I think institutional buying could continue past this point, but I think at the very least, institutions that kind of wake up to Ethereum when the price starts rising, they'll look into this, and I think they'll discover that it should be worth at least 30 to 50,000. And to argue that, I start going through kind of an ensemble of different valuation models. So I look at stock to flow, which is just a Bitcoin analogy. And I show how if you look at the historical Ethereum to Bitcoin ratio, you look at stock to flow, and then you have these changes. Suddenly Ethereum has a negative stock to flow. That is to say, each year there's a negative flow, there's a deflation of the circulating supply. I argue that deserves a premium. And so I kind of show how, okay, if Ethereum is just being valued at the Bitcoin stock to flow, then based on Bitcoiner price targets that a lot of institutions have adopted, Ethereum could get to 28,000 this cycle. But if you give it a premium over 28,000, a 5 times premium over that gets you to 140,000. Now, wait, my base case is not 140,000, right? But I argue, well, okay, what if you gave it a 1 to 2 times premium? And that gets you from 30 to 60,000, right? That's right in line with my base case.
Yep.
And it also suggests...
What is your base case?
30 to 50,000.
30 to 50, okay.
Right? And it also suggests at runway for, okay, when the price is going up, there's more narrative adoption, people have more conviction, people like learn and get excited. And if you're trying to see what, like in my head, the analogy I like to use is as Tesla price rose, you can see how analysts started adding things to their models. They were like, initially it was like electric vehicles, and it was like batteries. Then it was robo-taxi. Like, that's a new thing of like, oh, we didn't think to add the robo-taxis to our DCF models, right?
Yeah, and it's, oh, they can sell a computer too. Yeah,
absolutely. So again, this is a flows analysis, and I'm looking into the future, and I'm like, look, I can make a strong case, I think, for that, like 30 to 50,000. But no one's just going to hard stop there. I think there's a very clear valuation runway for if institutions want to keep buying into this, they absolutely will be able to, and they'll be able to justify it. I also use other valuation models. So I talk about, Raoul Pal has kind of famously on Twitter, he released a Metcalfe's law based valuation model where he regressed Bitcoin's price against the amount of active addresses. And he looked at Ethereum's path on that progression. And he said Ethereum should be worth 20,000 this cycle because its path along the progression was exactly where Bitcoin was in 2017. And so I pointed out that, well, in the 4 months since he wrote that post, Ethereum has bridged the entire gap in active accounts with Bitcoin and actually surpassed it. And so, Bitcoin is right now worth 5 times what it was worth in its 2017 peak. Yeah. So if Ethereum has now bridged that full gap, it should be worth 5 times what it would be worth at its like analogous 2017 peak. So if Raoul Pal says that peak is 20,000, it should be worth 100,000 right there, right? So Again, does it need to do you need to be that aggressive? No, you could say base case 30 to 50,000, but there's that runway. So, the narrative can drive price farther. Then, so I guess I'll stop there. My report, if you're interested, the report has like several other valuation models. I go through a discounted cash flow and I kind of get to similar conclusions. But I guess the last piece of it is just to say, you have to, in order to get, you can throw these numbers around, but I acknowledge that getting from 50,000 to 150,000 is $10 trillion of market cap. You can't just throw around, if it tripled last time, it'll triple again. I get that there's a diminishing return issue when you get to this size. So that's where it becomes so important that I talk about this illiquidity dimension. So just very quickly, Ethereum has this dynamic where when you stake Ethereum, you can't remove it in order to receive your staking rewards, your yield. And so I think that with the yields being so high, more and more people will stake their Ethereum. And even if they don't stake it immediately, they'll get in line. So you have to enter the queue in order to stake your Ethereum. And that means you're not selling it, because as soon as you leave the line, you have to get to the back. And so that's going to create a supply sink where suddenly, if you're looking to buy Ethereum, you're not going to be able to buy it from people who bought it, decided to stake it, and look away for 10 years. It's way easier to
be like a retail invest. It's like the opposite of a lockup expiration. It's like, I already have liquid shares. Let me lock them up instead. Now they're locked up. It's like going the other way.
Yeah, and the psychology is so friendly to it because you're receiving yield, right? So Bitcoin tries to build this hodl culture on this narrative of this is real money. Have the psychological willpower, don't sell. Ethereum says, no, do whatever you want. On a side note, I'm going to pay you 25% a year if you hold. So that's just economics, right?
Yeah. It's like on top of normal psychology, it's like, we'll pay you to hodl.
Exactly.
It's against.
It's hard to beat. And I argue it's whatever effect we're seeing in Bitcoin, I honestly think that hodling and that supply liquidity is a huge part of why Bitcoin is able to achieve $1 trillion market cap. Right. But we're going to see that magnified in Ethereum. And you can quantify it. So you look at the Ethereum that's locked in DeFi and the Ethereum that's been staked. Right now, that's 12% of market cap, right? And I talk about how if you look at the amount that would be staked to get yields to drop to 7%, which again, if yields are at 15%, nothing yields 15%. And hedge funds, you can arbitrage, you could short Ether to collect the yield. There are ways to get free 15% yields out of this if you want to. No one's just going to sit around and let that happen. So I don't see a world where
where's the spread in yield? Why is there a thing you can rush?
So let's say that in November the staking starts and there's 4.5 million stakers, and based on transaction fees, let's say it's a 20% yield, right? If you stake. And so interest rates right now, the equity risk premium is 5%. If you buy the S&P 500, you should not be expecting 20% returns, right? What you can do is you could buy Ether, stake it, and then you could go onto the futures markets and you could short Ether to cover your exposure. So now you don't have exposure to Ethereum's price, right?
I see.
But what you will get is you'll get your staking yield in Ether. Yep. You can get that staking yield, and that'll be a 25% yield, right? And so even if the price of Ether collapses, that's still going to be a substantial, kind of free yield that you can arbitrage. And that yield is not small. In a world with 1.5% 10-year interest rates, a 25% yield that a hedge fund can come in and do that. I think institutions are going to do this at size. I think it's going to be...
We'll incentivize them to go in, buy Ether, stake it, and then short the futures, just as a trade, a risk parity trade.
I mean, and that's assuming they don't look into this thing and say, this is the real deal. I want to just be a long-term investor, which I think, I talk about the narrative, I think could very well happen. But I think at the very least, short term, this is just free money lying around for a hedge fund with even a little bit of sophistication. And yeah, I can't imagine a world where the staking queue is not backed up tremendously until we get to reasonable yields. When you get to 7%, maybe crypto is a little risky, it deserves the premium. Okay. But for that to happen, 20% of the market cap has to be locked up in staking. And that's assuming that DeFi doesn't grow at all. But we've seen DeFi right now has like 9% of the market cap locked up. So if DeFi grows, which again, the price of Ethereum rising brings attention to this space. So expect it to grow. Scalability, we haven't talked about much, but that's going to come online. I expect DeFi to grow. And that's just going to cause more and more to be locked up. And so when I talk about it has 50,000, but it has this runway to 100,000, runway to 150,000, sounds like $10 trillion of inflows. But with the incredible illiquidity, it could be more like 50 billion, $100 billion that moves that. And sure, that's a lot of money, but when we're talking about the kinds of like an ETF coming in could soak up like half of that, you know?
And since the price is set at the margin, you don't need inflows equivalent to the market cap increase, right?
No, you don't. Exactly. I just point that out because I think that's a misconception a lot of people have, where they go 16 trillion. I mean, how could it, who has the money to buy 16 trillion, right? Exactly. And I agree. And I just say like, it's just not like everyone's not going to be able to just sell at the price point where it's 16 trillion and get that in cash. That cash will not come from anywhere, right? But that doesn't mean the price can't get there, and that some people who hold liquid ether will be able to sell, or even if it's staked, that you at those prices you couldn't like go in and short futures and lock that price in for yourself. Yeah, I think you absolutely will be able to.